Welcome to the channel. Today, we're conducting a detailed quantitative analysis of Canadian integrated energy company, Cenovus Energy. We're going to move beyond the headlines and dig deep into their financial statements to build a robust valuation framework. We'll analyze their capital allocation, operational performance by segment, and construct a discounted cash flow model based on the most recent data. Let's get into the numbers. First, let's break down Cenovus's capital expenditure strategy. According to their 2024 annual report, the company is in a significant investment phase, with a planned capex of $4.6 billion to $5 billion for 2025. This is not just maintenance, it's targeted spending on major growth projects. As stated by CEO John McKenzie, this is when capital spending is projected to decrease as major projects are completed. This includes the West White Rose project, which is on track for first oil in 2026, and optimization projects at Foster Creek and Sunrise. This decrease in capex, combined with new production coming online, is expected to create a material rate of change in free cash flow from 2026 onwards. While the company's guidance is for capex to drop to around $3.5 billion by 2028, a healthy dose of skepticism is always warranted in the energy sector. A more conservative estimate might be in the $4.20 to $4.5 billion range. Section 2. Deconstructing the financial performance. Let's look at the numbers from their latest reports. The strength in 2024 was driven by the upstream business, which posted an operating margin of $11.1 billion. This was thanks to record production from their oil sands assets and strong realized pricing, which benefited from the narrowing of the WTI-WCS differential after the Trans Mountain Pipeline expansion. The downstream business, however, faced headwinds. The U.S. refining segment, in particular, was impacted by weaker market crack spreads, leading to a downstream operating margin shortfall of $312 million for the year. This highlights the cyclical nature of the refining business and its sensitivity to market conditions. As of their Q1 2025 report, the company continues to show strong operational performance, though the financial results will always be tied to the volatile commodity markets. Section 3. Shareholder returns and balance sheet strength. Cenovus has made shareholder returns a clear priority. In 2024, they returned $3.2 billion to shareholders through base and variable dividends, as well as share buybacks. This is a very solid return, especially for a company that is still in a heavy investment cycle. The company has also achieved its $4 billion net debt target, which has triggered their capital allocation framework to return 100% of excess free funds flow to shareholders over time. This is a significant commitment and provides a clear path for future returns. Section 4. Valuation and discounted cash flow, DCF, analysis. 1. Oil price. We'll use a conservative long-term price of $75 WTI, which aligns with the company's own long-range planning assumptions. 2. Discount rate, WACC. We'll use a 9% discount rate, reflecting the risks of the energy sector. 3. Perpetual growth rate, a 2% terminal growth rate, in line with long-term economic growth. Free cash flow projections based on 2024 annual report and Q1 2025 trends, 2025. $3.8 billion, reflecting continued high, but disciplined, capex, 2026. $6 billion, significant increase as West White Rose comes online and capex begins to drop, 2027. $7.5 billion. Full year of new production and lower capex. The calculation. Discounting these cash flows back to today at our 9% rate. Present value of a 2025 free cash flow is $3.8 billion per 1.09 1 equals $3.49 billion present value of 2026 free cash flow. $6 billion per 1.09 squared equals $5.05 billion present value of 2027 free cash flow. $7.5 billion per 1.09 cubed equals $5.79 billion. The sum of these discounted cash flows is $20.35 billion. Next, the terminal value, using the formula FCF_2028 1 plus G. WACCG. Terminal value equals $8.5 billion asterisk 1.02 0.09 0.02 equals asterisk $123.86 billion. Present value of terminal value equals $123.86 billion per 1.09 caret 4 equals asterisk $87.75 billion. Section 5. Conclusion. The bull versus the bear. Our DCF analysis points to an intrinsic value of approximately $108 billion. Macro tailwinds, geopolitical stability and growing export capacity for Canadian oil provide a favorable environment. The bear case, risks outlined in their annual report. Downstream volatility. Refining margins are cyclical and can be a drag on earnings, as seen in 2024. The valuation appears compelling, but it is not without significant risks. Thank you for watching.